All right, so welcome, ladies and gentlemen. I believe we're in for a treat today. This is Merritt here with S&B Futures, and we have with us Peter Davies from Jigsaw Trading. Really excited about listening to his talk today. Peter is he's almost a guy in the industry that really needs no introduction. He's definitely one of the go-to guys when it comes to order flow, the E-mini S&Ps, things like that. He's really kind of a staple in the industry. He not only does he run Jigsaw Trading, which provides really cool tools for reading order flow and executing trades, but he trades himself. So around here we find that extremely important. If you're going to listen to somebody, they need to be able to do it themselves a lot of times. I've done several talks with Peter over the past couple months here, and I have to say that I've really enjoyed them. Peter's one of those rare guys that when I talk with him, everything just kind of clicks. It makes sense. He really knows his stuff, and I think that comes through loud and clear. So we're happy to have him on and allow him to share his wisdom with us here today. So again, I'm really excited about the talk. I think oftentimes order flow gets too complicated. It's seen as something that's kind of this dark, magical thing that's perhaps even dead in this day and age because of HFTs or spoofing or whatever. And that couldn't be further from the truth. So I haven't seen this talk before, but I'm really excited about the title and what I do know about what he's going to share with us. So with that said, Peter, take it away, brother.
Thank you, Merritt, and thanks all for coming. Let me just share my screen. Okay, I'm going to presume you can all hear me. One question at the start. This is about order flow generally. It's not really tied to any particular market. One of the only things about equities markets, there tend to be bigger spreads, which makes some order flow techniques different. Okay, so James Rowe saying screen is black. Can you see the screen now, James? Right. Okay, so today we're going to discuss some of the benefits of using order flow in trading. It's kind of a basic introductory thing. It's not the most basic, but it's one of the basic introductory webinars we do. It's really for those new to order flow and a refresher for those already using it. And as usual, we're going to try and keep it light on terminology so that we don't kind of get tied up in that and confused with that. Generally speaking, I'd like to hold questions till the end, but if there's something you get stuck on, just holler and then Merritt will keep an eye on that and interrupt me. Now we're going to start by visualizing things in simple terms so that the concepts are clear in your head. Now, obviously, when you go to a live market, everything's a little messier than these simple terms. But if we can just get these concepts into your head, you need that theory in your head before going to practice. But we also want to make sure that you don't have like 3,000 rules in your head before you go to apply something practically. So we're just trying to look at the most practical things that you can think about in simple terms that you can actually apply. You know, if you've got 5,000 rules to do something, it's just a total waste of time. You know, so this is stuff that you can apply in real time. And the majority of retail traders, right or wrong, are trading off levels. So in a lot of cases, they're trying to determine a point at which the market's going to turn around so that they can, capture the majority of a move. And I call those levels major reversal points. And I do that because I'm an intraday trader and there's all kinds of reversals in the markets. There's other traders are looking for, market to establish direction before looking to get another pullback. And I call those minor reversal points. Other traders are looking to capitalize on short-term ranges, fading extremes. Some traders looking to trade breakouts. But, these are the most kind of common techniques in the retail world. So it's worth considering these areas of trade first. But basically what most retail traders have in common is that they look for levels to trade off or to trade around. Now, some of you might be thinking, well, don't all traders do that? And the answer is no. But that discussion is kind of beyond the scope of what we're looking at today. Now, the dilemma with levels that traders face, you all face, is pretty simple, right? We can turn at the level We can turn before the level, we can run through and reverse, or we can just run straight through. And obviously, if we wait for a level to be hit, we're going to miss the opportunities where the turn is just before the level. If we trade ahead of the level, because we want to make sure we don't miss it, then we're going to have maximum risk because we need to consider the cases where it runs past and reverses. Now, you can, of course, scale into a position, nothing wrong with that. But there are ways to refine your entry so you can enter at a better time. Now, I will say that when you're looking at levels, the better time might not be the best price. Sometimes the better time is when you've got more confirmation, and quite often you pay for confirmation in ticks. So with order flow, it's the same thing. You know, you can wait for one order flow signal, two order flow signals, three order flow signals that happen in a progression. And by waiting for the other ones, you get more confirmation, but the market's going to be moving against you when that happens. And there's really nothing wrong with that. So order flow gives you the opportunity to fine tune these entries or get more confirmation getting later, you know, by looking at the activities of traders and how the market trades around these areas. It also helps you to analyze the behavior of traders after you enter a trade to help you decide whether to stay in the market or not. So, you know, you may well have the market move against you after entry with weak order flow and just decide that you're going to stay in the trade. Now, this isn't where I'd recommend starting with order flow, but absolutely nobody listens to the advice. So I'm going to show you what's first, second, and I'm going to show you what's second first, because this is what you want to see first. So tape reading and order flow analysis, we hear the terms, basically the same thing. You're simply watching the flow of orders and their impact on price to see how the market participants are acting and where they might be getting trapped. Now, many novice traders approach the market looking for mechanical signals. You probably all started out like this, right? You're looking for a combination of fixed factors, indicators to give you a red light, green light. And a lot of traders, they go over time and they build up this kind of dictionary of different things they're going to look at mechanically. And the theory is that that's the easy way to trade, right? To just say, right, I'm going to find some mechanical setup that I can just execute like a robot, and that'll be easy. And it would, but the reality is that the markets really aren't mechanical in that way. And if they were, you'd still have billions of combinations of fixed factors to find that one magic signal that works in all markets, in all time frames, in all conditions. And this is one of the reasons this kind of mechanization of trading is one of the reasons that people spend 5, 10, 15, 20 years without getting anywhere with the trading. Now, order flow is the absolute opposite of that. It's discretionary, right? And if you don't use order flow now and you're thinking of bringing it into your trading, you've got to really embrace that, right? You've got to embrace the fact it's discretionary. Don't try and mechanize it, right? Now, discretionary doesn't mean no rules. And there's also no law that says discretionary approach is more difficult than a mechanical approach. In fact, you know, that process of working your way through hundreds of mechanical trading systems is just like trying to find a needle in a haystack. And it's all or nothing, right? It either works or it doesn't. With discretionary trading, you are developing a skill. And so your progress is in steps and it should be measurable. You should actually see yourself progressing. And order flow is a bit like reading a story, and every story is different, but the language is still the same, right? You don't read another book and have to learn a language to read a different book. And it's the same with order flow. Order flow has its own language, and that language describes the behavior of traders. Now, a good example of this, a few examples of this would be a market, for example, where sellers are predominant and price is moving down to a level of support. So as you get to an area of support, you might see one of several things. So for instance, you might see large sellers on the way down, and you get to your area that you think is going to be support, and the big sellers disappear, and all we see is small retail participation. And in that case, what's happening is the behavior of some participants is changing. We could get support, and we've got big sellers, big and small sellers hitting aggressively into the level before, during, and after we go through the level. In that case, there's no observable change in behavior. We could get to the support level and nobody wants to sell at a certain price. You'll see this all the time, right? You'll get to a price, nobody wants to sell it. Like, you'll trade 500, tick down, 400, tick down, 300, tick down, 12. And it's like, whoa. And then it'll tick back a bit, Go back to where it did, traded the 12 and you're like 30 will trade. And it's like a price that nobody wants to sell. It's not a guarantee, but it is a signal, right? It's a sign. And there's a clear and observable change in behavior, kind of like a lack of commitment to trade at one or more prices. You could get to the area and sellers keep hitting aggressively, but the market is no longer reacting to that selling, right? So sellers are still there, but the market's no longer moving down. And in that case, sellers are getting trapped. When there's a considerable amount of selling, but no move down, that's where we have the stuck sellers, we have stuck traders. Another thing we might see, we might get to the area which we think is support, and suddenly it just boom, ticks up, large size buyers just come from nowhere, obvious buy side aggression, buyers initiating a new move up. So when it comes to reversals, right, we basically have three different things to look for in the order flow. The first is absorption. Okay, and that's where the sellers keep selling, but the bidders add to their bids and absorb all the selling. And often this is known as an iceberg order, but you don't really need there to be an iceberg order there for absorption. Sometimes you'll see the bids there, sometimes you won't. So that's one thing you're going to see in a reversal. Another thing you see is sellers fading away. One side gives up. Sometimes that's noticeable. Sometimes there's a pause, sometimes there isn't. But basically, one side gives up, often with a pause in the action. And the third thing you'll see is buyers jump in, right? The other side starts to push the market against the sellers, usually with an imbalance of 1.5 to 2 times buyers to sellers. Now, these three things, they're not mutually exclusive, right? You'll often see one, then the other. And the other thing about these three things, like the buyer stepping in, price might wiggle up a little bit before that happens, right? But the kind of reversal is confirmed when they start hitting in, right? So, these are three things, fairly basic things. There's a lot of variety with them. But how often would you see these things? In any one reversal, how often would you see one of these things? Well, that's actually the wrong question. The question is, how could a reversal occur without one of these things happening? And the answer is it can't. The market can't reverse unless you see one of these things, one or more of these things rather. So in any reversal, you will have one or more of these elements, and reversal really can't occur without them. So it's not so much a matter of whether they are there in a reversal, but how obvious they are, right? So if you think about it, what we're saying here is, the sellers are going to start on the way down. Somebody's going to absorb the selling, so the market no longer moves down, or the sellers kind of ease off, and then buyers jump in. It's three basic, simple things, but the market's not going to fully reverse, without the buyers jumping in or with the sellers, still hitting the gas, unless somebody steps up and absorbs. So it's not really a matter of do these happen do these happen all the time? It's just a matter of sometimes they're going to be more obvious than others. Sometimes they're going to be easier to read than others. So where do we look for these things? Well, as you know, there are things that you can't just see in price, right? So price shows you where you traded, but it doesn't show you how you traded. So before I show you the absorption of the stuff, I'm going to talk about one other aspect of order flow analysis, and that's using volume profile to understand where the trades are positioned, because it's really important to understand the difference between looking at price and looking at order flow. Now consider this image. Basically what we have here, we have a high and a low. And on the volume profile, we also have a high and a low. So the volume profile is showing us how many contracts we traded at each price. And this would just be like a price chart, a line on close, showing us where we actually traded. Now, if you consider this image, we've got a low here and a high here. And from a pure chartist perspective, that would be your support and resistance, right? That would be where you're looking to see where the market might react. If you're considering the volume profile, and the volume profile shows you where people actually traded the most, and where people actually traded the most is also related to something else, which is where their actual positions are, especially if that's today's volume profile and we didn't move too far away from it, so they haven't stopped out. So what we can see here from the volume profile, if I was looking at this volume profile, considering where price is now, which is about where this 243 is, it shows a market where the majority of positions are in this area here. And we've had a low volume probe kind of below and above. And there's no sign at all that the traders in this area have been stopped out. So someone look at this volume profile that understands volume profile analysis, understand a few things. So the majority of positions are here. There's no evidence that any significant amount of the traders positioned here got stopped out as we moved up, because we just don't see the volume there. We would see more volume. So as such, it's quite likely that when we come down here, we'll actually trade through that range again, right? Now, if the volume here in this upper probe was a lot higher and a lot longer, we could actually surmise that some of the shorts in this area had been stopped out. And with that one difference, it now becomes a lot more likely that when we trade back down to here, just above this 22,000, that area will hold. Okay, it's not a guarantee. I'm just saying it's more likely. And it's based on nothing more than a fairly basic understanding of how people feel and behave after losing money, right? And I'll just go over it just so you see it is interesting. So if you imagine there's a whole bunch of positions in this area here, right? You know that as we're trading and we've probably, you know, it probably wasn't as clean as this, it's a bit of a range. So we've got a whole bunch of positions there. Some will be long, some will be short. Now, what happens if you look at the S&P and a lot of markets like that, you'll see this happen as the market moves up. You'll have a little range, and it'll pop to the upside, and you have another range, and pop to the upside, have another range. And it's amazing how many times you'll actually come back and trade one tick above the range. And what's happening is very simply, you've got an area where a whole bunch of traders are positioned. Some are short, some are long. When the market spikes up and the shorts get stopped out, you kind of create almost a psychological future imbalance, because if you just lost money trading an area, so if you were one of the shorts positioned in this area and price came back to here, it's not the most obvious thing is not to go short there again, right? And everybody can see that shorts got stopped out. So basically, when you go back there, it quite often holds purely because the shorts just lost money there, and longs are quite happy because they've seen a nice pop in their direction. And you can watch that yourself on the S&P, the amount of times it happens. And my explanation might be right or wrong, but I think it's right. But it's basically just returning to an area where shorts lost money, and it just means that you have fewer people willing to commit shorts. Now, before we talk, we will look at the reversals, but I did say that I'm going to show you what comes first, second, because before we look at the reversals, which everybody wants to look at, much less sexy than the order flow activity that accompanies turning points is something called momentum. And you can't really talk about order flow without discussing momentum. And reading momentum, to some extent, is the easiest order flow skill to learn. It's less attractive to traders because it's not associated with turning points. But let's forget what to do with this information for a second, just consider what it is, right? So when a market has momentum, it's moving in one direction overall with larger participation on one side. So on a move down, you'd expect, especially on a thicker market like the S&P, you'd expect much more market sell orders than buy market orders, usually 1.5, 2 to 1. Now, reading momentum is relative. It's relative to how a market was moving before. So it's not something you can instantly read on a brand new market. And this is where the kind of feel comes into it. People talk about the feel, got to get into the feel of the market. And it's a bit like pulling out of a junction in your car. When you learn to drive, it's pretty hard to gauge when it's okay to go. But after a while, you learn how to really annoy other drivers by pulling out, like with a few seconds to spare. You know, you start to recognize the momentum of the cars coming your way. So the bottom line is there are many occasions where a market has clear momentum on one side, right? And for all the use of being able to read reversals, right, these reversal signs, if you can't read momentum, you will be the victim of it. So for all the good you can do from reading reversal signals at levels, if you can't recognize momentum, you're going to get run over a lot, right? So momentum helps in a few ways. So first of all, entering a trade against momentum is going to see you offside almost immediately most of the time, right? So if you see momentum against you, you really should consider waiting, right? Quite often it means you're going to be able to get in the same trade a little bit lower down, if you're looking to go long. Entering with momentum, just momentum is a thing. Not everyone is trying to buy when the market's moving down and sell when the market's moving up. If you watch any market, you will see very big traders trading with any move. So if you're watching the S&P and the S&P is moving up, you're going to see 100 lot trades going through over and over again in the direction of the market, right? So these are not small traders who didn't catch like the bottom of the move and so they're just the stupid guys getting in late. Managing a trade with momentum and price is better than managing with price alone. And again, trade management is a little less sexy because people just want to people are always interested in where to enter the market. But there is more than that. There's more than just entering. So if the market wiggles against you with low momentum, it's not the same as a momentum move against you. So being able to read momentum is the benefit you'll be able to take advantage of earlier in your order flow career, as it basically relies on the market continuing to do what it's currently doing, as opposed to reversals where you're trying to read the market switching and doing something else, right? So with momentum, if you just think about it from a probability perspective, is it more likely at any point in time in any market that it will continue to do what it's doing or that it will stop and do something else? And generally speaking, that's why a lot of traders purely trade momentum, right? Because all they're trying to do is trying to trade a market instead of trying to catch a falling knife. All they're trying to do is see a market that's just carrying on doing what it's doing. So we've got everything we talked about so far has all been about orders, okay? But there is another part of order flow analysis. We've got the orders, we've got the positions, which is, to me, it's the volume profile where we can kind of presume where positions and stops are. And then the other kind of aspect of it is the resting orders or the limit orders in the market and how they've been manipulated. So usually that means that trades are either hiding their real intent or putting in large orders to deceive you into thinking the market's stronger or weaker than it actually is. So we'll see iceberg orders where a small amount of liquidity is shown, but actual supply and demand is higher. And we see spoof orders where, orders simply disappear when price gets close to them. And, when people look at this and they look at the dome, it's like, ugh, I don't like that because it's got numbers on it. And one of the reasons that people actually use the dome, it's not really to look at the numbers at all. It's really it kind of gives you a really good way to see the market moving up and down. So, a lot of retail traders, they look at the market as something that moves left to right. But if you think about it, all it does is moves up and down. And when people are watching the dome, they're really just watching the market moving up and down. But if you had to gauge the importance in terms of the importance of information, of the bids and offers compared to the actual trade execution, I'd say that the information about the trades executing and the volume profile contains about 10 times as much actionable information as the bids and offers. So you'll get 10 times as much use from the actual orders and the volume profile than you will from the bids and offers, right? So if the bids and offers weren't there, you could still be an accomplished order flow trader, right? Now, in fact, quite often, like I say, when the markets are moving, it's really not so much about the numbers themselves, but really the overall momentum in the market. And so this is me sitting on a prop trader's desk. And if you look at his screen, he's actually got I think there's 22 domes up. And the charts themselves aren't a big part of his game. So what he's doing is actually just looking at, to a great extent, the way the markets are moving overall and the way the markets are moving in the moment. And with a lot of prop traders, quite often the trades are as simple as the market's running, let's jump on board. And it's a far cry from the complexity a retail trader tries to build into their decision-making framework. Now, we'll look at a few things on the Jigsaw tools. And what we can see here, we can see bids and offers here. This, there's heat maps out there. Two ways to look at the bids and offers. You can see a large bid here, down here, 629, and you can see a large bid here on the heat map. But like I say, it's still the trades and positions that are most significant. It's still the tape, the trades at price, the areas like this area here where we've got an exceptional amount of volume traded, the absorption, right? So if you compare trading to a poker game, showing a large bid is a bit like showing your cards to the other players, right? There would be no point to do that unless you want to plant ideas in their heads and you've got some sort of bluff going on, right? So the bids and offers, they're always suspect. But what ends up trading at a level, that's always 100% reliable. So if you see 500 contracts trade or 1,000 contracts traded at a level, that's what traded there, right? With the bids and offers, it's just what they might trade, or it might be real. So when I look at the bids and offers, I just think of them as that's a heads up. So if I look at this area here, I think that's just a heads up that something's going on, right? Trading against them, buying directly in front of them is a process known as front running. If you try and employ that just as like a one rule strategy of buying in front of big bids and selling in front of big offers, you will absolutely lose money, right? You will absolutely lose money. You can try it in a sim account if you like. There are scenarios when you can front run a large bid, but basically if you front run a large bid, what happens is if you see the 629 here, you'd be looking at the bids in front, right? So if price came down to here and these bids started growing in front of the 629, that kind of tips your hand a little bit, because you can actually see other people are front running, and the market's actually, you've probably got much higher probability that those orders that were added are actually real orders, regardless of whether this one was or not. But to be honest, it's not something, even though I see it, it's not something I trade personally. So there are scenarios you can do it, but we won't go into that too deeply. So we're going to come back to this slide later. But one thing to understand is that, what we're looking at here is just different piece of information, right? So what we've talked about so far, we haven't really talked about a set of techniques. So we've just got order flow is basically information more than technique. So don't think of order flow as a set of techniques, or that you need to master every aspect of it before taking the first step. So all of the order flow tools you see on the market, they're all based on a common set of concepts. And we've just gone over a few of them in a few slides, right? We've gone over actually most of them in a few slides. So think of order flow in the same way you think of a price chart. Order flow tools present certain information in a logical manner. And like price charts, there's actually lots of ways to use that information. So there is no one way to use order flow tools, but there is one rule that is really important, and that is to keep it simple. Because as we mentioned, and as you all know, that a lot of novice traders, they go through this period of adding more and more indicators to a chart, looking for that perfect combination of indicators to tell them when to get into a trade. And what they'll do, they'll add more and more and more indicators, more and more things to their charts. And, I've done screen shares with people, and I'm just horrified of what they got on the chart. You can't even see the price on there, right? And what happens is they've got that many different things there. They can't make a decision. It's analysis paralysis. So part of the problem is that every indicator they add is basically just slicing and dicing the same information, the price. So if all your indicators are based on price, then you're still just trading price. It's a lot of bells and whistles, but they're all dissecting the same information. Now, as traders progress, they realize that, maybe all these indicators, maybe that's not the answer. And over time, they drop, the majority of the indicators, and they keep the charts fairly simple. They quite often go a bit overboard in terms of timeframes, but that's a different matter. So a lot of these traders that kind of saw the wisdom in keeping their charts simple, they make exactly the same mistake when they adopt order flow. So instead of keeping it simple, like just saying, right, first thing I want to do with order flow, I'm going to use momentum to stop me getting into trades that are going to run against me straight away, right? So that to me, that's the ideal place to start. Just use momentum to keep you out of trades that are going to just run against you, right? Second, use momentum to help you manage your trades, right? So instead of doing that, bringing in one or two order flow elements at a time, they'll go out and they'll find every order flow indicator they can off the internet, add them to their screens, and guess what? Same deal, same analysis paralysis. So it does pay to keep things simple and not turn into a science project. And those that do keep it simple, they'll actually see progress in hours when they first start to look at order flow. Okay, and it's not a joke when I say hours. I'm talking with what we do. We actually give you some drills to do at the start, and when you first do those drills, you'll sweat and you'll be focused and you'll have a headache after the first hour, and it will seem really difficult. Then after 7 or 8 hours of doing those drills, hopefully not all on the same day, you'll actually start to see patterns emerge, right? And that's kind of how quickly you'll start to see things happening with order flow. It doesn't make you an expert. You're not going to be an expert in 2 weeks, right? But if you do keep it simple, you actually will see some progress. Start looking for momentum, as you adopt order flow. You won't become an expert, but you will start to see some patterns recur. Okay, so the best way to look at order flow is not as an all or nothing thing, right? We've got beginners techniques, we've got advanced techniques. There's entry techniques, management techniques, exit techniques. You can use it in really short-term trading in the market for seconds, or longer-term day trading in the market for hours. So the best thing to do is first choose a benefit, a focus area, get the most from that, right? It might be, I would say trade management is the best thing to start with. And when I say get the most from it, I mean really see some measurable improvements in your performance before you then move on to try and implement another benefit, right? What you can't do is try and become an expert in all techniques in one go, because as keen as you might be, it's not going to get you anywhere any faster. You know, I've seen people adopt order flow, and 6 months in, they'll email me and say, Pete, I'm not getting anywhere. And I'll say, did you do the drills I sent you in the first week? And they'll say, no. And I'll say, okay, go and do the drills. And then I'll get an email a week later and I'll say, okay, yeah, I see it now, right? So don't try and run before you work. And many, like I said, for many, the best place to start is trade management, because that gives you the ability to cut your losers quickly, let your winners run, and also get to recognize when a market's really running in one direction. Okay, so it's all based on momentum reading techniques, which is much easier than the techniques we use for trade entry. And it should give you major leap forwards in weeks, right? You should be able to improve your trade management within weeks reading momentum, right? So let's kind of have a high level view of what's important. So like I said, with order flow, you're effectively interested in two basic things, right? Firstly, what happened before, and second, what's happening right now, right? Because what happened before clues you in to where people are positioned, right? So in this image, we can see, if we look earlier on, we've got an area where traders got stuck, right? The circles show areas that traded a lot of volume. That's the absorption. So these traders got stuck. Kind of a possibility, I guess, that they are now stopped out. They got stuck before the market opened, but we don't really know. But we know that's a significant area. This is actually a few minutes after the opening of the S&P 500, and the X's here. I put these X's in, and they represent areas of high volume from the overnight session. And if you've ever watched this, if you actually look on the S&P if you open close to an area where there's a lot of volume, the market often bounces off one of those areas into the open in the first few minutes. So basically, this is the kind of high volume into the open, and this is the current volume profile where we've traded since the open. Right, in the center of the DOM here, we've got something we call current trades, and that shows what's trading right here, right now, this time round, right? If we leave an area for a few seconds and come back, it will go back to zero. So what we can see is we've moved up here. This is how many contracts we took to move up through each level. So we traded 125 buys, ticked up 345 buys, 609 buys, 174 buys, 42 buys. And now we're here. We've bought 690 contracts, which is a lot for this market on this day. Did tick up and trade 57 contracts, but didn't get anywhere else. Now, on the tape here, time in sales, we're showing just the larger trades. It's mixed, but the market did move up. We can see the market moved up from the open at 59.25. And we can see that we've got probably, you know, it's mixed, but you can see that there are some buyers in here, and buyers from 60, and the buyers haven't got anything for their money, right? But we can see also that the sellers have been trying to sell and they haven't got anything for their money. So this area here, the extremes of the high volume area from overnight, is already an area where I'm expecting a reaction, right? We've moved up to that area or a few ticks below, and now we've got stuck. So the buying is no longer causing the market to move up. So what we can do? Well, we've got a few things we can do. We could sell here. Now, this is the beauty of some of the order flow setups, right? With a lot of order flow setups, we're actually leaning on something. You know, I'm sure you've probably heard Merritt saying we're going to lean on that. So we're leaning at this point. If we sell this, we're leaning on the fact that we've moved up and the buyers are no longer getting any getting any love, no longer getting any move up for their buying, right? So if you lean on that, if you're saying, right, at 690, I believe the buyers are stuck, where's your stop loss going to be, right? Your stop loss doesn't have to be at 65, right? Your stop loss is normally going to be, you know, three or four ticks above that level. Because if you're saying the buyers are stuck here, if you're saying right here, right now, the buyers are stuck here, it shouldn't go up anymore, right? Now, this is going to vary by market. On crude, you're not going to expect the market to hold to the tick. On US Treasuries and a lot of times on S&P, you can have that expectation of like having an order flow event. It doesn't necessarily have to be a high win rate opportunity. It's more of a high risk reward opportunity, right? So with something like this, we've moved it up. It's an area we think that's going to hold anyway. We can see the buying's no longer getting us anywhere. It gives us a close stop. It doesn't have to give us a really high win rate. It's a close stop, great risk reward ratio. Now you can see a resting sell order here. That's something I put in at the extremes before the open. That's obviously not going to get hit, right? In fact, if that order gets filled, the premise for the trade is wrong, right? So if the market's stalled, I'm at position 149 in the queue here. At 27.60.25, 57 contracts traded, and we've ticked down, right? So I can see that maybe the kind of premise is that the buyers are trapped and, you know, they're not interested in buying anymore. So the order flow is telling me, yes, market's probably going to move down, but absolutely not am I going to get filled at this price. So the chance here is to miss the trade or get in at a worse price. Okay, and what I always do is get in at the worst price because I will trade confirmation for price. So anyway, what happened is the market moved down, and again, this is the low. So the X's again marked out where the high volume area was, close to where we were trading into the open, and we can see we've actually moved to the low of that area. Now we've done webinars before on trading the open. That you can go and have a look at and look at how that trade plays out. But you just have to trust me for now that it is a significant area. So what's happened is we can see we sold 145, tick down, sold 274, tick down, 121, 329, all the way down. And now we sold 672, right? And guess what? We're not ticking down. So we're effectively seeing the same thing down here that we saw at the top, right? So we can see we've sold 672, we've bought 252. So we've also got a little bit of an imbalance. We've got a lot of sellers, right? Now, one of the things about this imbalance, if you see an imbalance like that, it doesn't mean, you know, we got 672 sell market orders, 252 buy market orders. The smart buyers are on the bid, right? The smart buyers are on the bid. So quite often when you get to these turning points, you do see an imbalance because there's no point buying at market at the moment because we've got some sellers selling into the bid. So if you look at the bids, there's 119 contracts bid or 119 buy limit orders, but we've actually traded 672 contracts. And actually all the time that we're here, we were just showing about 100 contracts. So as we traded, the bidders just added more contracts. So at this point, we can actually see that 710 contracts were added to the bid while we traded here. And if you've ever heard of an iceberg order, that's what an iceberg order is, right? So sellers sold, the bidders just added more bids, slowly trapping those sellers. So not only are we at a point, the kind of the bottom of the high volume area from overnight, we've kind of moved down to an area where we think we need to do business. We're now seeing the sellers not get anywhere, and we're also seeing that the bidders are trying to be a bit sneaky. They're hiding their size, but they can't hide their size from us because we've got this column here that tells us what they added. So before we move on, just remember that 27.57 we traded 3 contracts. We just sold 3 contracts down there, right? Because if you look at 27.57, that's all we traded. We traded a few more at 57.25. That's all we traded there. So another 11 contracts, I think, at 57.25. And then the market lifted up. Now the market's gone up. Guess what we see again? If you look at the size of the trade on the way up, right? What can we see? This is exceptional. We can see a circle here. The circles also show us where exceptional size trades. I tend not to be looking at the circles, to be honest. To me, this kind of charting It's just basically lets you go to the toilet. And then you can come back. When you come back, you can see what happened. But in real time, I'm just watching this and just watching, and I can see, the market's stuck. The momentum's faded. The market's stuck. 1,076 traders bought 2,761. Market's stuck again, or very likely to be stuck. And again, this is something that goes over and over. And different markets do it, kind of represent it in slightly different ways. But you get the picture though. We're leaning on areas. The market's temporarily stuck for entries and exits, for good risk-reward ratio trades. Now, that's not the only order flow trade there is. There's lots of different types of order flow trades. Some of the best trades are when a market's pulling back and we just run out of steam, right? And it's a good trade for one reason. There's not so many sharks around there, right? So with this kind of setup you're looking here, where you've got the 1,000 buy orders, there is a chance that somebody might nudge that market around to push people out of position, right? If you take a pullback that's got low volume, or if your market's moving up overall, you pull back down, run out of steam, no more sellers, there's nobody to nudge out of position in that area. And so that's a better trade. But most people like this trade the most because it's kind of big, obvious, and ugly. Right? But the bottom line is these trades are common sense. They're not based on some abstract concept. I mean, if I think of an abstract concept like Fibonacci, I'll say to people, why does Fibonacci work? And they'll say it's a pattern in snail shells and leaves. And I'm like, yeah, but why does it work? With this, the reason it works is because 1,000 contracts traded, the buyers probably realize they're stuck, and there's a good chance they're going to unwind by selling, and the market's going to tick back down. So to me, you're not trading on abstract, you're trading on something that's a little bit more solid. Now, another interesting trade, we saw this earlier, is a volume spike. Now, this is order flow still, but it's a completely different story. Now, you've all seen these. Market breaks, runs in one direction, huge volume, and you just think, oh my God, I'm missing out. It's going to be huge. It's going to go forever. I can't stop. I can't stop. I can't stop. And then you sell it and you've sold the low of the day. So we've all done that. We all know the kind of excitement and fear of missing out and, the feeling of getting caught at the bottom. So we should all appreciate how the traders trapped at the bottom here feel. It's disappointing. It's a little bit scary, right? But what is also scary is actually buying this, right? But not so much if you use order flow, and you can kind of understand that you will get some confirmation, but you might end up buying it instead of the low. You might end up buying it a little bit higher if you want the extra confirmation. So when you see these big fast moves, what you'll see is you'll see a lot of volume here. Now the red and the blue here is the balance of trade. So the reds are selling, the blue's buying, right? And you'll see these clusters of positions. So you see a cluster of positions here, and you see a cluster of positions here. So the cluster of positions itself isn't something you'd kind of trade. I mean, you could if you're really aggressive, but to me, you would get run over a lot. So you see this cluster here, you see this cluster here, then the markets start to lift, right? Now we can see below us, there is a big bid, 629 contracts at 51.97, and it was there as we came down to here. But those bids aren't the important thing. What's important is the positions here. Real positions, real traders, really feeling like they might have just sold the low, and so a real make or break point. So once the market starts to move up through these traders' positions, they exit. Some will exit early, and their exits will push the market up a little bit because they have to buy to exit. And then you'll see that cascade, and that's why you kind of get this initial snapback. You get a kind of a big snapback, right? So you'll see clusters of volume all the way down on volume spikes. Like I say, one here. But the key, as I say, is when the market actually pushes up and starts washing these traders out. Now, this kind of goes against what a lot of the price action traders do, where they say, I've got to buy the low, and if I kind of trade here, it's too late. I'm getting in the middle of the move, and I need to buy the low, and I need to have my stop here. Well, in this case, you're trying to buy before the majority of the traders realize they're getting stopped out. So you want to see some kind of aggression on the behalf of the buyers. You don't want to be getting in up here. You see aggression on behalf of the buyers, and then you want to get in. And if that aggression on behalf of the buyers fades, then you get out again. Whether you're up a tick or down a tick, or up 3 ticks or down 3 ticks, you're kind of looking for that momentum to continue, right? And if it doesn't push up, you've got no trade. If there's no cluster volume, you've got no trade. If you have those things, it means you've got a good chance that sellers are getting stopped out. And in the short term, that could give you a nice little, on crude 7, 8, 10 tick stop run. Doesn't mean it will guaranteed continue, but it means you've got like the beginnings of a move, right? Something that happens a number of days on DAX, a lot of times down DAX, 4 or 5 times on crude, gold, natural gas. And we've all done it, seen a market break out. It moves some, then it moves some more and more and more. And we see it move, we feel bad, we missed out on this huge move. Looks to go on forever. So we finally get in and we've traded the end of the move, right? So understanding how the traders feel in that position is good, because you should be able to relate to that, because you, I, and everyone else in this room has been that trader. So it's a similar concept, understanding about other traders' positions and them getting caught out. And this is, like I say, it's something most of you should do, because you've all been caught out yourself. You're no different to everybody else in trading. Now, of course, not all order flow is about getting caught out, but it's always about other traders, about concepts you can relate to, not just like 2 lines crossing over each other. 2 lines tells you nothing about actual behavior occurring in the market at that time. So the common theme is that it's all about other traders, their position, their fear of loss, their actual stop losses, and then protecting their winnings. So if you're completely new to all of this and you wanted to start to kind of add some of these common sense techniques to your trading, our recommendation is basically to try and build on what you have right now. Because with retail traders, there is this kind of desire that each time you see something new, to just throw away everything you already know, and just open arms with the new thing, right? So start off refining your trade entities, using momentum for trade management, or using it to scale into trades. Whatever you do, as you add more techniques, make sure that you're refining those techniques, getting the most from them before you add something, and not just like scrapping everything and starting again. So we'd rather you keep what's working, enhance that, than start over again. Of course, if you're trading moon phases and the color of your favorite morning show host t-shirt, then obviously you might have a rethink about how much to keep. So I'm not going to give you a big sales pitch here, but I do want to talk about the learning curve and where kind of we fit into it. So like I said, everybody's different. And I talk to a lot of traders, and they come to us with different levels of experience. And I'm always happy to have a call with people to figure out what to focus on first. But here's the typical changes traders that I talk to, new to order flow, make when they join Jigsaw. So the first one is reducing the size of the losing trades. And this, like I said, this is one of the simpler things to do with order flow. So all of you watch price after you enter, but the addition of order flow, just the balance of trade in the order flow, is really useful. So you might see price move against you, but with very even trade or low volume. And at that price, you don't really have risk. You might see the market move against you on really high volume with an imbalance against you, and you can get out before you hit your stop. There's also techniques for getting out of trades that go your way initially, then fail. So a lot of the times what you'll see is you'll get into a trade, an S&P trade, it'll go 3, maybe 4 ticks and just not get anywhere. It'll just die. And for me, when I see that, that's just an automatic exit. I don't sit on those trades, right? Again, because so what you're looking for is basically a lack of momentum. Yeah, it might have gone your way, but there's nothing behind it. There's no pop. There's nothing's happened, right? Like I say, so as I said before, that's utilizing the most basic order flow technique, which is reading momentum. And with that, you should be able to get improvements fairly quickly. Now, the other benefit, really important, is trades that just watch one market are kind of disadvantaged. So, markets, generally speaking, have a higher chance of follow through if they're moving together. So, for example, if you're watching the Dow Jones and the NASDAQ, when they're not moving together, the S&P will typically be range bound. And that changes throughout the day, most weeks I'll get an email, an email from a trader saying that, I had something that worked and then it stopped working, and they're not able to tell when the market conditions are changing. So one of the other changes that we really recommend is to actually start to keep an eye on multiple markets. If you're trading crude, the dollar index, the Canadian dollar, crude doesn't have that great correlations, but it has great momentum. If you're trading interest rates, then obviously you got different length treasury products and bonds. If you're trading indices, then looking at the Dow Jones, Nasdaq, S&P. If you're trading Eurex, looking at the bund, looking at the Euro stocks, all that kind of thing, trying to get a feel, not just for the order flow in your one market, but actually the order flow across the board, because sometimes it's the other markets that will actually tell you to stay out of the trade in your market, right? So a great example would be if you want to go long S&P, but the Dow and the Nasdaq are screaming downwards, right? And you're about to go long in the S&P, it's not a good idea. It's just not a good idea. So that's another thing that we point to people towards. And of course, refining your entries, right? It is a must for all traders. And for some, it's a bigger change than just getting a better price. It's understanding sometimes that the later entry at a worse price is the better trade, right? Sometimes it's better to let other traders reverse the market, give you confirmation that you actually have a new direction, and then get into a higher probability trade. And then what we're also trying to do is to get people to start to recognize patterns, to see things in the market you haven't seen before. So watching order flow does help you keep focused on the markets, believe it or not, because there's always something going on. So if you think about watching a 5-minute candlestick and watch 5 minutes of order flow, there's obviously going to be a lot more going on in the order flow. And obviously you can't let that keep nudging you out of positions. But as you watch the order flow and you get used to seeing it, you'll start to see other kind of like pure order flow setups in action. Whether you take those or not is up to you. How you react to them is up to you, but you'll start to actually see these patterns playing out. So if you do adopt order flow, it's not just a matter of throwing everything out, and it's not always just the most obvious thing, like I'm going to look for absorption and then I'm going to buy, right? Try and keep your perspective fairly wide on how you're going to use it. And in terms of how we kind of help people in 3 ways. We've got the trading platform, really good trading platform. We've got institutional traders using it. We've got an analytics platform as well. So you can actually analyze the results of your trading. It's a real-time trade journal analytics. And then we've got the education. And basically, we believe that they just feed into each other. So you've always got to have that feedback in your trading. I mean, I know that you do webinars with Brett Steenbarger, so I'm not going to go into that too much. But it's having that feedback cycle. So we do give you the tools, we do give you the education, but we also give you a way to kind of get that feedback as well with the analytics tool. And then in terms of the packages that we have, we basically have 2 sets of packages, basically. If you're not sure what you have, basically, we have the independent professional, and it's very simple. If you've got something that's worth improving, you want one of those. And if you're not sure which one you want, get the cheaper one and you can get the other stuff later. So basically the way it works, the independent gives you the tools, the analytics, the chat room, and it gives you 10 hours of order flow education, right? That's going to keep most people busy for a while. The professional is basically just layering in other education, but it's not like the kind of education where you're going to watch it and you're going to watch it the weekend and do it on Monday. It's like literally stuff that should keep you going for a few years. So for instance, the trade management aspect to it, you would probably take a few months to implement what's in that video. So it's like not something you're going to cram. So that's for people who've got something that they want to improve. The institutional one is people that come to me. I do get people that come up to me and say, I've been doing this 20 years. I don't get it. And I'll say, well, okay, what have you got that works? What have you learned in the 20 years that does work? And they'll say nothing. And I'm like, yeah, that's funny. Yeah. I'm like, but really, what have you done? What have you learned in the 20 years that you want to keep? And they're like, no, seriously, nothing. And that's what the institutional course is for. It's like for people who are just completely green, hands up in the air, give up. And it's just a more complete end-to-end thing, which is probably not appropriate for people in this room. So if any of you do sign up today, there is a coupon code, SMB100, gets you $100 off any package. And with that, Merritt, did we lose all the questions when Zoom crashed, or do we have some?
We like to do things a little different here. We like to take a intermission and really just throw everyone. Yeah, we lost all the chat when we did. So if you had a really important question for us, please repost it, and we'll get to it as good as we can.
Mhm. Yeah, I mean, Phil saying I'm trading the NQ. I'll have an ES DOM up right to the NQ DOM. Yeah, I mean, it's really important. Merrick, what do you do about correlated markets? I mean, you're trading mostly crude.
Yeah, I'm actually kind of whether this is right or wrong, my approach is that I typically say correlation schmorrelation for me. If I'm, and I understand that's a very different game when you're focused on trading equity indices and you look at the breadth and the, what's going on across those various indices. That makes sense to me. But when somebody says to me, hey, crude oil has had a 0.78 correlation over the past 6 months with gold or something, I say I do not care, because correlations come and go in those more diverse asset classes. So
Absolutely,
that would be
yeah.
my.
I mean, for me, with correlations, I think the key is the less volatile the market is, the more the correlation is important. So if you've got, like, when you're looking at crude, you get these big runs that you can take advantage of.
Right.
And once it's running, it tends to go. With the S&P, you do have to be a bit more precise, and I think it comes down to that. But like, you're right. I mean, the correlations with interest rates kind of broke when they took the interest rates down to zero.
Sure.
So indices. No, it's not the correlation. So Phil's asking, the indices the only correlated markets.
No.
No. If you're looking at if you look at energy, there are energies that are correlated, but not great. Sure. Indices, treasuries, some of the agricultural products, obviously. Yep. So yeah, currencies as well, obviously.
I think that the thing that turns me off so much with correlations is that they're retail traders, beginning traders, get this idea in their head that, the yen and the euro have been correlated or inversely correlated or whatever, and they see one start to tick up, and so they say, well, that's free money that I can buy the other one. It just does not work that way.
Yeah, I mean, I saw even the other week, I saw in a forum somebody saying that the Dow 2-minute leads the Nasdaq 5-minute. I don't even know what that means. I mean, I don't know what that means. But like, it's like as if I'm not like, well, if the Dow has always moved first, arbitrage would come in.
Yeah,
and it would
disappear.
It would disappear, and it's absolutely not. So on the indices, it's about participation. You'll either see really you'll either see lackluster markets with no order flow, and the S&P is going to range if that's happening on down the Nasdaq, and then you'll see times it's really bubbly and everybody's it's a little party.
Yep,
and
yep.
Then
or everyone's scared, peeing their pants. That's important too. There's a really good question here from, I can't read the rest of their name. Is it Ivan, or all I can see is Iva? Do you see that one?
Valentini. Yeah, it says pretty clear that order flow is useful on short-term time frame. What about more long-term? Well, I'd say if you were investing for the next 5 years, it'd be pretty wild to use order flow to refine the entry on that trade. I would say if you're day trading, it's very useful. Possibly if you like short-term swing trading, although it would never. If I was like short-term swing trading in a couple of weeks, it wouldn't be the priority, the first thing I'd learn. But I would say any form of day trading, that's where we stick. And I think outside of that, if it's a 2-day trade, then maybe. But, once you go into the weeks holding time, I think to me, it doesn't seem like the right thing to focus on.
Yeah, well, I believe both of us will have the recording of the webinar that we'll send out and whatnot, whether you're coming from Jigsaw or from S&B.
Now, Serge asked an interesting question. When or after how many minutes does the DOM work for you? That's a really good question, because you do have to. You can't just sit down at the markets. Okay, that's not true. There are times when you could just get in and turn your platform on and enter a trade, but only because the markets were running a lot. But you'd still want to know what was behind the move. You'd still want to know what had hit the market. Most of the time, like for 9 out of 10 times, markets just moving up and down because of speculation. And in those cases, you really need to sit down. I mean, Merrick, what's your time? I mean, how long does it take you to tune in?
Man, for me, because I am kind of already monitoring how things are evolving pre-market leading up into, let's say, the 9 a.m. crude open.
Yeah.
I don't have any type of rule that says I have to wait until 9:02 before I trade or something. I really I understand there's likely going to be some shakeouts, a little bit of just people executing orders, so there's a little more, a lot more volume and gusto there in the open. But that's something that I really kind of get in the habit of seeing, and I'm prepared for it. So I don't know. It's interesting, and it's really going to depend on your style and what you're looking to do. One thing, for example, I use VWAP in my trading, and certainly VWAP takes time when you start a session before you start to lean on it, because it takes volume and time to go to build and build and build before that becomes a useful indicator.
Yeah. So Serge, you sound like it's a good example. DAX with no pre-open data. Well, I think DAX is a different matter because, DAX, when DAX opens, they usually before, when you got the Germany open, it's usually pretty quiet for the first hour. It can not quite often be quiet for the first hour, and then London opens, it takes off. But yeah, I wouldn't trade DAX in the first minute when it's just opened. I'd like to get a bit of context first. And with Merritt, he's looking at, he's watching it before the 9 a.m. open, which is really, it's not really an open, it's just a switch in participation.
Exactly.
But yeah, I think you have to sit down and get into it and read your news, watch it move a little bit, and then start to get involved with it. But I'm like Merritt, I've got trades I take off the open, but I've marked I've been watching it before the open to see where all the volume traded.
That's right.
It just you tend to get little bounces in that area, so it kind of lets you trade early. So, Merritt, you guys, what do you pay attention to the most right after the bell when trading the open? You can answer that first, Merritt.
Well, it's going to depend on the day. There's some days where I don't really pay attention to anything because we're opening in such a dull trade location contextually. I pretty much know that there's nothing for me to need to pay attention to. So I think that's important. But to more specifically answer your question, I've already got pre-established areas where I see where really good risk reward is. So I'm simply watching for price to come into those areas. Again, whether it's at 9 a.m. at the moment it opens or whether it's at 9:15 a.m., I don't care. So as price comes into those areas that I'm interested in potentially doing business, it's all about the order flow. It's all about, for me, gauging the strength and weakness of buyers and sellers, seeing those held bids and offers, seeing absorption there where it's occurring. A lot of the stuff that Peter talked about.
I can tell you for the S&P, there's a couple of things you pay attention to before the open. First of all, if the futures have moved a long way from where they were the night before, there's a kind of rebalance with the stocks and the futures. And sometimes if the S&P's moved like 30 points from where it was the night before, I'm expecting, to me, whatever first move is kind of irrelevant, and I tend to stay away. If that's not the case, I'll just I like to look for areas of high volume from overnight that are quite close to us, where I think those positions might still exist, and those are the areas I look at. But I'm like Merrick, if the market's been really slow, I'm more interested in trying to find an entry close to the open. Because if you get these days where it opens up and you get a little bit of a flurry and then it just dies out. And if you've had that for the past 3 days, then you expect it on the fourth, and you're then trying to get something a bit close to the open because it might be the only volatility you get. I think we're good for questions, Merritt.
Yeah, just the last one there by Eric. The platform, the website is right there at the bottom of the screen. You can see right now, jigsawtrading.com.
Yeah, for those asking about the courses, there is a page on there with that stuff. But if you are interested and you go to the website, I'll man the chat on the website for the next 30 minutes if you want to have a chat.
Awesome. Well, Peter, thanks for coming on, man. I mean, it's great stuff as usual. Really like to listen to what you say.
Thanks, Merritt, and thanks all for listening. I appreciate it.